All right, today we're diving into Panasonic's latest quarterly report, and honestly, it's a real head-scratcher. The company sold less stuff, but somehow managed to make more money. So let's get into it and see how on earth they pulled that off.
And that right there, that's the central mystery we're trying to solve. You know, it's one of those classic business puzzles that seems completely backward, right? How do you boost your profits when your sales are actually dropping? It feels like it shouldn't be possible, but the answer tells a really fascinating story about strategy.
And here are the numbers that create the puzzle. Just look at this. Compared to the exact same time last year, their total sales took a pretty big hit, down 10.6%. But, and this is the crazy part, their operating profit actually went up by 3.8%. So what in the world is going on here?
Okay, so to get to the bottom of this, we first have to really understand these top-line numbers in a bit more detail. Let's unpack the two key figures that are seemingly telling us opposite stories.
First up, we've got sales revenue. For the quarter, Panasonic brought in 1.9 trillion yen. Now, that is a massive number. We're talking roughly 12 billion US dollars. But a number that big doesn't mean much on its own. It's how it compares to last year that really starts to tell the story.
And here's where you can really see the scale of that drop. Just look at the difference. Revenue fell from 2.12 trillion yen last year all the way down to 1.9 trillion this year. That's that 10.6% decline we mentioned, a gap of over 200 billion yen. That's a lot of sales that just vanished.
Okay, now let's look at the other side of this coin, the operating profit. And just as a quick reminder, this is the profit a company makes from its main day-to-day business, before you account for things like taxes and interest. For Panasonic, that number was 86.9 billion yen.
And this is where the plot thickens. The profit didn't fall with the sales, it actually climbed from 83.8 billion yen up to 86.9 billion. That's a 3.8% jump. So there it is, our mystery in plain sight. They sold less, but they made more. How?
Well, the answer isn't in these big total numbers. It's buried in the details. So to really figure this out, we have to peel back the layers and look at the different parts of Panasonic's business. Let's see which divisions are pulling in opposite directions. And boom, here we go. When we break down Panasonic's business, the picture becomes so much clearer. You've got lifestyle, connect, industry, and energy, all chipping in. But look at that very last line. Automotive. 0 sales. 0 profit. That right there is our first huge clue.
So it turns out that massive drop in sales wasn't because Panasonic sold fewer TVs or batteries. Nope, it's because an entire business unit, Automotive Systems, which was worth almost 300 billion yen in sales last year, is just gone. They sold it off.
And this is the aha moment. This is why profits went up. By getting rid of its lower-margin automotive business, what's left behind is a leaner company where the most profitable segments are now the stars of the show. Lifestyle and energy. We're talking home appliances and EV batteries. They now make up more than 75% of the total profit. It's a classic case of addition by subtraction. So, it's clear they made a massive strategic move to get more profitable. But pulling off a huge shift like that can be tricky. So, can the company's finances actually handle it? Let's do a quick financial health check and see how they're managing their cash. So here's the story of their cash flow this quarter. They generated a really healthy 180 billion yen from their operations. But they also invested a ton, 194 billion, into future growth, like building new factories. And on top of that, they paid out almost 90 billion to investors and on their debts. The result? Even though they were profitable, their actual pile of cash on hand went down. But that little dip in cash isn't really a red flag, not when you zoom out and look at the bigger picture. With over 9 trillion yen in assets, against roughly half that in liabilities, the company's financial foundation is incredibly solid. That's the kind of stability that lets you make these big, bold investment moves for the future.
Okay, so Panasonic is leaner and more profitable. That's the story of this quarter. But what does the company expect for the rest of the year? What kind of challenges do they see coming up on the horizon?
Well, in their own report, Panasonic points to all the usual suspects for a global giant like them. They're watching the health of major economies like the US, China, and Europe very closely. They're worried about currency swings, potential supply chain problems, and of course, staying ahead of some really intense competition. These are the headwinds they're bracing for.
And this is interesting. Despite this quarter's strong profit numbers, Panasonic is actually being pretty cautious about the full year. They're forecasting that both their sales and their profit will end up lower than last year. So that tells us they think those headwinds we just talked about could pose a real challenge in the coming months.
And really, that brings us to the final big question. Panasonic made a really bold strategic move here. They have become a leaner company that's laser-focused on its most profitable businesses. But the question is, will being leaner be enough to navigate the pretty serious economic storm clouds they see gathering on the horizon? That is going to be the story to watch.